In this video, I am going to break down the previously mentioned two engines of value growth powering the high-growth companies and try to reveal a factor hidden in the two engines, which is valuable in understanding why a mature company is also able to reward investors as much as a high-growing one. Some case studies will be presented with the opportunities to exploit the new findings. Okay, buckle up, let's roll out. At the beginning, let me steal a quiz from a presentation of Sabre Capital Management LLC to shed light on the hidden factor. From the year 2000 to now, stock XYZ has had these results over the last 22 years. XYZ earnings grew 8.9 times, that is 10% per year. P/E ratio went from 13 to 19 or 1.5 times, that is 2% per year. So the quiz would be, what is your estimate of XYZ's total return? To give you a hint, according to my growth tracking model, you may use an earning variant to replace the revenue growth to get an answer, which is 8.9 times 1.5 equals 13.35. That is to say, for the past 22 years, the stock price of XYZ has been 13-folded or compounding at 12.5% annually. Not bad, isn't it? Is this your answer too? Wait a minute. Would you like to give a second thought? Let me rewind a little bit to review the growth tracking model. Basically, growth tracking model is attributing compounded stock price for the long run to two factors: growth of sales per share and change in the P/S ratio, or for the earnings variant, growth of EPS and change in the P/E ratio. There are two charts, demonstrating how the model is applied to Microsoft and Amazon respectively. As you can see, the purple bars stand for the growth rate of revenue for the trailing 12 quarters or TTM, the green-blue bars stand for the free cash flow margin, the yellow line with dots stands for the P/S ratio, the light brown line is the stock price adjusted for dividends and stock splits, and the black line is the market capitalization. Both companies are great ones, rewarding its shareholders for the past 13 years with great increases in their stock prices. But can you tell the difference out of the similar pattern here? One of the most noticeable differences is Microsoft's free cash flow margin is much stronger than its revenue growth, while Amazon's purple bars are all higher than its green-blue bars, representing that the focus of the management has always been growth rather than generating free cash flow. Please note that the two metrics share the right-hand side axis dominated with percentage. Another significant deviation is the overlap of two lines, price and market capitalization. Whereas Amazon's price and market capitalization lines are entangling all the way, Microsoft's price line has been deviating from the market cap line from the very beginning. This difference definitely raises a question: what has been driving the price much more than the market cap of Microsoft, and why hasn't it been driving AMZ's? Actually, the first difference could give us a clue. The revenue growth of Microsoft has been staying under 20% almost all the past 13 years, leaving the management with abundant free cash, which was used to reward shareholders by buying back stocks, causing the price change to escape from the gravity of market cap. Amazon has been employing a different strategy with its free cash flow, i.e., reinvesting a large portion of its cash in the core business, such as AWS. The two different strategies by different companies give us a window to peek the value growth secrets through. For a fast-growing company, like Amazon, when the reinvestment opportunities are tremendous, the company tends to reinvest the majority of the cash flow from operations to expand its business, making the growth of value represented by the growth of revenue/earnings or sales per share/EPS. On the contrary, a mature company like Microsoft has a gigantic amount of cash but limited reinvestment opportunities and thus tends to reward its shareholders with buybacks. This financial strategy makes the growth of value of this kind of company still represented by its per-share metrics but not by the growth rate of its absolute financial numbers, like revenues or earnings. Put in another way, one of factors powering the growth of value of a company is the growth of sales per share or EPS, could be broken down to the growth of revenues or earnings in the absolute terms and the change rate of retirement of shares outstanding. Microsoft, compared with Amazon, although has lower revenue growth rate but has a solid trend of retiring its share outstanding. Okay, let's revisit the quiz at the beginning of the video. Do you have another idea of the solution? Please pay attention to the description of the quiz, especially this one. XYZ earnings grew 8.9 times. Right? It doesn't say EPS grew 8.9. Now do you have a clear picture of what is going on with XYZ? Take a close look at this chart. Isn't it quite similar to that of Microsoft? So, by now it has been very clear that the answer to the quiz. XYZ, actually AutoZone Incorporated, is a leading retailer of automotive replacement parts and accessories in the United States. The company has a strong focus on customer service and a wide selection of products. AutoZone has been successful as a public company due to its aggressive expansion strategy and its commitment to customer service. From the year 2000, in addition to the growth of earnings and change of P/E ratio, the company cumulatively retired 83% of its shares outstanding, inflating EPS 5.88 times totally or 8% annually. The simple equation is 8.90 times 1.46 times 5.88 equals 76x return. Okay, in the nutshell, the growth tracking model could be broken down to three engines of value growth: growth of revenue or earnings in the absolute terms, inflation of multiples like P/S ratio and P/E ratio, and retirement of shares outstanding by buying back shares. In the previous videos, I have spent plenty of words on the first two factors, so now let me spend some time on the repurchase of stocks. Repurchase of stocks or stock buyback is when a public company buys back its own shares of stock from the open market. Companies do this for a variety of reasons, including to increase the value of the remaining shares for shareholders. When a company buys back its own shares, it reduces the number of shares outstanding. This can lead to an increase in the price of each share, as there are fewer shares available for purchase. To return cash to shareholders. When a company buys back its own shares, it is essentially using its cash to repurchase its own stock. This can be a way for companies to return cash to shareholders without issuing a dividend. To improve the company's financial ratios. Some financial ratios, such as earnings per share, can be improved by buying back shares. This is because the company's earnings are divided by a smaller number of shares when there are fewer shares outstanding. Stock buybacks can be a controversial practice. Some people argue that they are a way for companies to manipulate their stock prices and that they do not benefit shareholders in the long run. Others argue that stock buybacks are a legitimate way for companies to return cash to shareholders and that they can be a sign of a strong company. For a company to be able to buy back its own shares, abundant free cash flow is a prerequisite as demonstrated by AZO and Microsoft. As a rule of thumb, a free cash flow margin above 10% is desirable and 20% of margin could make a company a candidate for buybacks if it has not yet exercised. Another consideration on if it is a good exercise to repurchase stocks is the timing. If stock price remains subdued at the obviously undervalued level, buyback is increasing shareholders' value, but repurchase at a euphoric price is a means of destruction of value. This breakdown is meaningful because it reveals that multi-baggers are not the restricted zone for mature companies that are typically characterized with slow growth of either sales or earnings. It also unravels the trajectory for a mature company to be multiple-folded, matching the concept on which the growth tracking model is based. At the end of this video, let me examine a popular giant high-tech stock from the perspective of the three-engine growth tracking model to give a best guess of the future trajectories of the stock prices. That is Google. For the past 13 years, Google has been able to grow its revenue at 21% annually with 20% free cash flow margin. Even though since as early as 2015 Google has started buying back stocks, the total percentage of shares bought back just accounts for around 10% of the shares outstanding. It can also be discerned from the overlap of the two lines in Google's chart, but things have changed in recent years, where the two lines began branching, indicating the company has broadened its repurchase plan. In fact, in April 2022, Google's parent company, Alphabet, announced a $70 billion share repurchase plan. This is a significant increase from the company's previous repurchase plan of $50 billion in 2021 and accounts for nearly 5% of the market capitalization. This acceleration of buybacks sheds light on the future trajectory of stock price appreciation. The little equation tells the story. We assume annually 15% revenue growth rate for next 20 years, the same P/S ratio of 5 times at the end of 20 years, and 70% of the shares outstanding will be retired. Here is the little formula. 1.15 to the power of 20 times 1 times the reciprocal of 30% equals 54, which means if the future stays near to the assumption, Google will be a 54 bagger at the end of 2043 or 22% annual compounder. If you believe as much as 80% shares outstanding will be bought back, the number will go up to 82 times or 24.5% annually. Breaking down the growth to the absolute terms and the shrinkage of shares outstanding makes the growth tracking model compatible with excellently cash-abundant mature companies, which could also be a beauty of compounding. Let me finish this topic with another stolen example from the same presentation.